I would say number one is location. Secondly, cash flow. Cash flow is really important for me. Personally, appreciation can be slightly speculative. We would all like to think that, we're going to hit, a 2x equity multiple, but, having some cash flow along the way is really, really nice. So I definitely think that is certainly not to be looked past. So I like those two as my number one starters there. I would also say vintage. Not that I'm mad or I'm ever going to want something too old, too new. I just need to know what the vintage is, for what reasons, because it needs to match the business plan to be logical. So those are my top three right there. And if I would go down to the next ones, I guess location and market's pretty big there. I would say those three key ones are really solid, and then maybe positive leverage.
Welcome to the Peak Profits Podcast, your guide to maximizing returns in passive real estate investing. Hosted by Bryan Morris and Chris Ward of 7 Peak Capital, we dive into conversations with industry experts, sharing insights, strategies, and stories to elevate your investment portfolio. Whether you're a seasoned investor or just starting out, this podcast is designed to give you the edge for financial freedom. Get ready to unlock new opportunities, discover the secrets of successful investing, and take your passive real estate investments to the next level. Now, let's go reach those peak profits together.
Welcome back to the Peak Profits Podcast. Today, I'm excited to introduce Craig McGrouther, Director of Business Development at Lone Star Capital. With nearly a decade of real estate experience, Craig has mastered the art of building strong investor relationships and structuring equity deals for multifamily projects. He sold over 100 homes, has a passion for multifamily investing, and brings a unique perspective with his background in urban and regional development from the University of Arizona. Craig, welcome to the show.
Thank you. And I'm very impressed that you had perfect pronunciation of my last name. Not that I ever get offended by it, but it's rare that someone says it first rip, not even asking prior. So very good. Thank you guys for having me on today.
Yeah, of course. I know we've known ourselves. Well, I've known you for probably 6 months now, so I've heard it a few times. So I've had practice, but
Yeah,
I had to prep for the podcast to make sure
right.
I said it properly.
Very good. Very good. Well, excited to chat it up and go through some fun topics today.
Absolutely. No, thank you for jumping on. We're excited to have you. Obviously, we work together to some capacity here, but look forward to future partnerships and working with you guys. So we're excited to have you on. So why don't you get us started? I touched on it briefly in the intro. You did start out your real estate journey in single family homes. Believe you're a realtor back in the day, and now have transitioned into working at Lone Star Capital, specifically in multifamily. So can you just talk about a little bit how you got into the real estate industry and kind of where you're at today?
Yeah, for sure. So essentially, I kind of growing up wanted to sell homes. Kind of bizarre. I was watching HGTV and ESPN. So don't know why that was the combination, but it was in fact. Maybe mixed in that with some MTV and like Viva La Bam and those brain rot shows. Before there was TikTok and YouTube, there was that form of brain rot. So I was watching stuff like that, and I just love flipping TV shows for whatever reason. It made sense, and I always felt kind of just tangible. And I don't know, maybe it was just a young capitalist in me, but I always wanted to make a lot of money. And selling homes, if you sell expensive ones, well, you get big checks. So that was always my thought process. I was doing that in the Silicon Valley Bay Area, Mid-Peninsula. So for those who don't know where that is, that's basically between San Jose and San Francisco. That Mid-Peninsula area, some of the richest land in the world, home of Facebook, very close to Google, all the big, kind of massive tech companies in that vicinity, close to Stanford University, UC Berkeley, Santa Clara, very rich land. Wanted to sell homes there, was selling them, was doing pretty well. And then I was kind of doing a mortgage calculator, and it was like I had a listing for like $3 million, and like the monthly payment, when you factor property taxes, insurance, mortgage rate, so on and so forth, was like $35,000 a year for something that like I didn't really want to live in. I was like, yeah, this doesn't really make sense. And that's post-tax too. So I was like, yeah, this probably doesn't make sense. So then I moved to Arizona, was selling homes again, and then I got reconnected with Rob Beardsley. We knew each other for some time before. He's the CEO and founder of the company, and it was a very organic fit. He didn't have a salesperson in his company, and I saw kind of the trajectory and the vision that he had and where the company was hopefully going to go. Did I expect it to go as well as it has? No, but I'm very thrilled. But essentially, I was kind of selling some homes. in Arizona. I was doing really, really well again, but there was just a piece missing. I didn't really love the idea of also showing property in 120-degree heat in Phoenix in the summer. And I really just wanted to ultimately, like everyone else, figure out a way where I didn't have to work so hard when I'm in my 50s. I'm 30 right now, or, 50s, 60s, and beyond. And, whether it be if you're a realtor and you're basically buying a bunch of rental properties because you've got that market knowledge, or if you're someone like yourself or you guys and you want to invest in, kind of alternative assets, whether it be multifamily, which is what we do, or other kind of various assets, you just basically want to put yourself in the car, in the vehicle where you can make as much as possible, where you can invest and live the good life. Like you guys, I like to be going to Europe in the summer. I like to, do all the fun stuff like going to the south of France like you guys. So I want to live that rich and fun and full life, have money kind of work for me. And it's kind of hard to do that if you're selling homes just because you're not that autonomous to certain extents. So really wanted to get in the vehicle to invest as much money as possible. And it kind of just worked out very organically that Lone Star was kind of that fit for me. So it was kind of a beautiful marriage of me going to that company, kind of integrating together, and kind of no looking back since then. So been with the firm now for about 3 years, and it's been crazy to see the growth of it. I think when I got to the company, we're at about $25 million of assets under management. And I think now we're about 700. So tons of growth, with a great team, and, looking forward to only continuing that and buying more great deals despite, the market cycle we're in right now.
That's such an impressive story. And again, I think everybody listening will resonate with the want to have your money working harder for you and want to live the luxurious life, right? Like the majority of people in this world, we look around and we see everybody, like you mentioned just before this, like the TikToks and things like that. All you see on Instagram and social media is people driving around in Lamborghinis, streamers doing all of these random things. And it's like, well, not everybody has the opportunity to do that, but we do have the ability to have our money work for us to make our lives, our families' lives, ultimately a lot easier. As the director of business development at Lone Star, like, what are your main responsibilities, Craig? And maybe I say that Craig slightly differently when we're talking about pronunciation because of my accent. It does always make me laugh when people say Craig instead of Craig. But I'm going to keep calling you Craig just because that's natural for me. Like, what are your main responsibilities, and how do you support the firm's growth and ultimately your investors' growth as well?
Well, seeing as that I'm also naturally from the British Isles as well, from I guess a genetic orientation, you're probably saying it correctly. But from a specific role perspective as to what I do on the day to day, it's really working with and talking with people like yourselves, developing relationships, harvesting, the next people that we're going to work with. What we also call it is capital formation. So essentially, I have to raise the capital for the deals. So what does that look like? We basically do risk capital for our deals. Pursue opportunities, pursuit costs, right? To buy, the 35 to $60 million assets that we acquire, these multifamily assets in Texas. So we put the money down. And then what I do is I basically go out and find the money for it. Now, naturally, you don't just snap your finger and have money appear. Like, as you mentioned, Bryan and Chris, we've known each other now for about 6 months, maybe a year or so. And although we've worked with you guys, you guys awesome. It was awesome. You guys invested in one of our deals, which we're very happy with, which is such a sign of credibility for your investors that you've kind of gone through the process of knowing what our systems are like to know that we're actually legit before you put their money to work in our deals, right? But I have to basically go around and find all the capital for our next opportunities. So what I do is, relationships, setting all of that up. So, when we do our deals, when we do raise capital, it's very much a jigsaw puzzle because we don't have one kind of blank check capital source that comes in for every single deal. Every single deal, it's a different story with different people, different investors, and it's my job to make sure that deal is filled up. So sometimes we've got 100 check writers in there. Sometimes it's a lot less, but it's always kind of, as I like to call it, a beautiful mystery. So really working through that, kind of doing some marketing initiatives, podcasting, really just spreading the brand out there, true BD, I would say, business development. So, doing kind of everything, going to conferences, setting up dinners, wining and dining, and hopefully taking people like yourself to play golf soon.
Hey, I'm all in for playing some golf. I know we'll be out in Phoenix next month together, so hopefully we can coordinate and get on a golf course. Since you know the area, you know the good golf courses around. I might
You
need
don't have
to
to threaten me. You don't
practice
have
my
to threaten me with
swing.
a golf date. Yeah, you don't have to threaten me with a
Yeah,
golf date. Okay.
You may
yeah, I
need to
haven't
catch
practiced
up
much.
together.
Yeah, I haven't practiced much in New York over the last few months. It's just been brutally cold, but I'll whip out the golf clubs and get some practice rounds at the sim before I show up in Phoenix.
Yeah, well, cold's all relative because I'm freezing my butt off here and it's about 60 degrees. But as we were talking about before we're on here, 60 is all very relative.
Yeah, I would die for 60 right now. It's about 25 degrees in New York right now with some cold wind,
Yeah.
um, but yeah, I'm looking forward to getting out to Phoenix. That'll probably feel warm for me. So that'll be a nice connection for us. But to your point there, like you guys do an awesome job and we're super excited to have partnered with you guys on the one project. And since we've closed, we've gotten monthly distributions and I know Chris can speak for it, middle of the month every month. Great monthly updates. I know Dasha sends out an email every month. You guys do a really nice job of seemingly having your systems in place for communications to investors. And that's an important part. And that's one of the reasons why we decided to invest with you guys first before we go out and raise our investor capital to ideally, potentially invest with you guys in the future on a larger deal. But with that said, I'd be curious to know some of your systems and processes and some of the, check writers and money that you bring into your deals. Like, what is the average check size? What do you do to generate right those investor relations to really get? Because you guys do a great job on social media. I think Chris and I can both speak for it. Like, it's like every day yourself, Rob, right? There's some type of content that you're putting out, short-term, perform content, podcast clips, just posts on LinkedIn about what's going on in the market. We see it. I'm sure thousands of other people see it. So you're really branding yourselves as the experts in the industry. So what are some of those systems you have in place today to not only generate interest, but to really position yourselves as the experts in the field and then to ultimately raise the capital for your deals?
Yeah, I think one thing that people really sleep on is just the art of doing everything how you're supposed to do it. And we're not doing anything that anyone else isn't doing. I just think it's the cadence and consistency and actually doing the little things over and over and over again. Like, for instance, you kind of mentioned, the check coming in at that said time and then getting the email. But it's not that we're doing something that people don't do. It's just the fact that, like clockwork, it's going to be there. So having everything be there and being consistent and predictable, I think really kind of puts people's minds at ease. And what we really want to do is basically have everyone sleep well at night and be really comfortable. So that's kind of some of our systems there and processes is kind of putting the nucleus of the team together, whether it be our VAs that are international that kind of help, all kind of, for instance, you mentioned kind of our clips and whatnot. I do about 2 podcasts a week or at least 2 podcasts a week that gets uploaded. Then they, splice it up, create the reels, upload it. So we just basically make sure that everything is systematized to a T. And it's kind of funny. Sometimes I'm even like lost for the systems that we have by having press name because it's kind of like little elves and fairies that I upload it. I don't do anything about it. And the next thing I know, I wake up, I check my email, I refresh it, and it says, oh, you just uploaded a video. I'm like, I uploaded a video. I guess I did. And then I get all these people liking it. And then I get random people from my past life, if you will, that message me, hey, I'm interested in this, interested in that. Or, hey, I really enjoy your so-and-so, or, whatever it may be. It's crazy that when you put the systems in place, just how much easier it is. So it's just basically stacking one little item on top of another, I would say. Got to run away, Mike. An item on top of another on top of another. And then from a process perspective, it's just doing it week in and week out. But I think it makes people feel comfortable. And then, from getting people to know, like, trust us. I mean, it's crazy to say, but even podcasting and stuff like this, when you're even if they don't even listen to it, if you're willing to put yourself out there, you just automatically seem more trustworthy because you're not hiding behind something, right? So that's a big one right there. But just putting enough information out there really helps the process. Like, for instance, especially recently, I would say the last 6 months, we've gotten a lot of the benefits from the podcast. But, for instance, there's people that have been listening to us for a very long time that, inbound into our system, and they write us checks on deals and they don't really ask any questions about the deals, which sometimes to me, I scratch my head about because I would have a question or two. Even if I don't know the answer, I just want to see you answer just so I can check the box of asking a question. Sometimes, as I say, asking a question just to ask a question. But you'd be amazed by how awesome that is. And then from the experience of other people liking our processes, they refer us people. And then someone literally referred us the other day, and he's like, yeah, here's $50,000. I'm like, what do you mean here's 50? He's like, yeah, just put it in your last deal. I'm like, okay. but it's kind of crazy just the trust that you do acquire from doing the right thing. And then, like clockwork, having, your processes in place from a really solid team. And, the other really crucial item to think about is it's not just Rob and I, we're obviously very public facing, but, we've got 150 people on our team between on-site property managers, between VAs, between corporate staff, the whole kit and caboodle, everyone there to create this infrastructure where folks like yourself can kind of get that check like clockwork. So it's really just a process and team oriented item where the system is really great, and feel very lucky to be with very talented people.
Yeah, one thing I want to actually add on that, which is awesome. I think Chris and I are both seeing that, and we're starting to implement systems into our business as well with VAs and starting to take some things off our plate that we can systematize. I just read the book Buy Back Your Time by Dan Martell, which like
Mm-hmm.
completely changed my perspective on like what can I outsource to people like based on the time value of my time throughout the day and like what I can get done. Amazing book, and like you guys seem to do it very well. And Chris and I are on the same path to try to systematize as much as possible as well.
Well, there's also a lag effect too, right? Like you might, for instance, on adding VAs and investing in yourself and your time and kind of your mental energy, you might put those processes in place today and get no effects today. But it's maybe a year from now, 2 years from now, 3 years from now that you really start to see that gain and that growth takes place. It just takes time, unfortunately. And, in this instant gratification era, unfortunately, time and patience is some things that I personally lack and other people really lack as well. But it puts things in perspective. And, it's kind of funny. If you look at an elephant, if you're going to eat it, you don't eat it all in one bite. You eat it chunk at a time, right?
I don't think I've ever heard anyone talk about eating an elephant before, Craig.
Well, but if you're going to do it, you would just put it all in your mouth, one bite, one slice at a time.
It's definitely a great analogy. Absolutely. So I do want to switch us a little bit from really your perspective of multifamily, because the multifamily market has had varying levels of success over the last few years.
That's a very good way to put it.
Lone Star have been able to come through that, right, successfully. And I actually watched one of the clips that you uploaded where you're talking about forced appreciation and constantly reinforcing appreciation. And you described it as there's only so many times you can put lipstick on a pig to essentially force the appreciation of that asset. But value add within multifamily is a very, very popular way that people essentially do drive value within that, but it's not always through forced appreciation. And what Lone Star do very, very well and are almost really seen as experts within is tax abatement strategies. So we'd love it if you could, number one, just share with our listeners what is a tax abatement strategy and how have Lone Star ultimately implemented that multiple times within your deals to help drive value for your investors.
Yeah, super, super great point there. And unfortunately, I think everyone is so mentally conditioned to when they see real estate, whether it be a single family residence, if they're buying a fourplex, which is, four, small, like, family homes, like the, top classic fourplex, four people live there, four different houses, dwellings, right? And whatever it may be, up and down from, a 600 unit property, right? People are so forced and conditioned to want to see value add. They want to see the heinous looking carpet and the disgusting old tired looking paint and terrible landscaping. And then all of a sudden the montage video clip up and then you see it looking, pretty and brought up to market par, right? Well, everyone wants to do that. And it looks really nice. And it's that HGTV brain that I have that everyone wants to see that. But in all reality, you need to get what's something called return on cost, which is basically if I spend X, I need to get Y in return on a yield perspective, right? And from 20, I would say 15 to 2022, basically, I would say the lion's share of properties that would be value addable have had that business cycle done to them. And if that's been done enough times, you can't do it again and again and again because there's not really a return of cost, right? And there's also a ceiling on rents that you can push. So it's hard to find value there all the time. Now, there are instances where it's found. You gentlemen and myself, of course, last year invested in a deal, Grand Riviera, which did in fact have a really unique story that for some reason, the deal didn't get value added, which is more for us. And we love those deals, but they're few and far between. Fortunately, when you work with a group like us, Lone Star Capital, you do get a nice level of sophistication with us because one of the co-founders, Rob Beardsley, of course, is, the CEO, co-founder, but the other co-founder is Ken Pruchikowski. And Kent was a senior tax attorney, worked at MetLife, worked at the IRS, worked at one of the big four, big five, that's what you want to call it, groups. So he's got that really awesome corporate background, legal background, but he's able to find nuances and value that most people would not be able to see. He's just an absolutely brilliant guy, right? So what he discovered was a tax exemption route, which basically we preserve some affordability because there's, of course, an affordability crisis all throughout the country. Texas is obviously subject to that as well, where we buy our properties. And we are able to find an opportunity where we basically take a property and we reduce our rents a certain percentage. And in exchange, we cap those rents going up over a period of time for a portion of the units. And in exchange for doing that, we get a drastic reduction in our property taxes. And what that does, and especially in a state like Texas, which has very high property taxes, that creates a massive net operating income, NOI lift, which is also transferable to the next seller. So that's the way we've been able to kind of create unique value right now that other people maybe don't have the legal complexity to do, or don't have the portfolio size, or aren't even interested in dealing with the kind of affordable angle for sure. So that's kind of been one of our saving graces from a value perspective angle. We're able to buy more deals, but also from a kind of a mission perspective, we're very passionate about providing that affordability, helping people that are in need, because quite frankly, since COVID, inflation's crazy, and it's not just in America. I'm sure you're experiencing some of that in the UK, but everywhere in Europe, right? It doesn't matter where you are, prices have kind of gotten crazy, and your basic necessities, which is obviously your housing, has, in a lot of cases, doubled in a very short period of time, and incomes have not doubled. So it's a very big problem, and we're able to kind of help with that. But we're also be able to kind of create a win-win-win. The city gets affordable units. The tenants get probably higher quality housing than they would get normally. And then, of course, our investors get a nice outsized return that is relatively more, or I guess less risky than a typical investment, because at closing, the exemption goes into place. So it's a really kind of fun, creative situation where all parties involved get a benefit.
Yeah, that's amazing too. As you mentioned, there's really a win-win-win for all parties in that scenario. So when you're discussing, I believe, so you guys primarily focus on the Houston MSA. I know you are starting to branch out in other MSAs in Texas, I believe. Dallas, we invested in a property, but also San Antonio, I believe. So when you talk about the tax abatements specifically, what does the structure look like? Is that a 50% tax abatement, 100%? I'm sure every deal is a little bit different. And like, what requirements do the state or the cities require of you guys? I believe it's average median income, right? So a certain amount of units need to be for a certain amount of tenants. So can you explain a little bit what that looks like from an operator standpoint once you put that tax abatement in place?
Yeah, so essentially we have to have 50% of the units be affordable. The other 50 can be market rent. Those can only go up with wage increases. So let's say if wages increase 3%, then those 50% rent controlled units can go up set at that clip accordingly. So we have a portion of those there. So, and then could you go through a couple other questions in there so I can make sure I hit every point that you would like me to hit?
Yeah, so say your property tax on a property that you acquire is 500,000. Is that like a 50%? Like you do, does it automatically
Great
become
question.
250,000 a year? Like what does that look
Yeah.
like?
So we did one deal in San Antonio last year that had a 50% property tax exemption on it, and that had basically the same affordable restrictions as the other ones we do in Houston. And then the deals we in fact did in Houston have that affordable restriction there, where they have to be at what's the income? 30% of the units need to be at 80% of the area median income, and then 20% at 60% of the area median income. And in exchange, we get about a 85% property tax exemption. But don't quote me on that, because these kind of systems are ever evolving and changing. So, what is here today will not be here tomorrow.
Yeah, so Craig, obviously that again, each deal is very specific. It ultimately will depend, and like you said, those could be ever changing. And again, I think a lot of the people that I certainly know in New York have heard about rent controlled apartments. It was almost like gold dust if you found yourself a rent controlled apartment. You, especially during COVID, you were like, well, this is great because I don't have to have those increases. And it's essentially a similar thing, right? And that's what you're putting in place, which is obviously amazing. When you talk about value add, that obviously does, again, you mentioned that it immediately increases the NOI. What other strategies do Lone Star put in place that help drive value for your investors within your properties?
Yeah, it's a great question. So another thing that you want to think about when you're, an investor, if you're a capital raiser, you want to be kind of aware of how big that person is in a said market and what their portfolio size can be. So we are vertically integrated. So the beautiful thing about that is we can actually really benefit from economies of scale and also geographical clustering of properties. So for instance, we have in the northwest pocket of Houston, like over 1,500 units. So we can kind of have economies of scale and really shave and save on payroll, which of course helps the cash on cash return and the overall efficiency of the property and ease of turning over units and things of that nature. And that's really not able to be done if you're kind of a one-off operator who's maybe buying a place in Des Moines, buying a place in Tampa Bay, buying a place in, San Diego, buying a place in Charlotte. There's no problem with any of those markets, but if you're all over the place, that kind of makes it harder. Now, this might sound kind of interesting and counterintuitive, but if I'm a capital allocator or an investor like you guys, I would want to be invested in all those different markets to get exposure, but I wouldn't want to work with an operator who's just kind of one off plucking deal here, deal there, right? You want to kind of be really focused with people that do it day in and day out because they know what a good deal looks like. So I think benefits like that really, really do help kind of the little margins there. And also knowing how to manage, knowing what payroll looks like, and also another thing that's really beneficial, not just on, kind of saving money, but just talent. Like if we sell a property, if we do really well, and we know we've got a really good community manager there, property manager, we want to make sure that that person stays in our ecosystem and our family and doesn't leave, and that good talent goes away. So we want to keep them. So making sure that we have the best of the best pertaining to, on-site talent, of course, helps everything, right? Because at the end of the day, it's funny, you pay these, property managers and whatnot, community managers, call it, $80,000, $100,000 a year, but they're really the lifeline of the business, which is in fact leasing the place up, obviously having good quality tenants. So making sure that you've got the right, really gatekeepers at the property is monumentally important. And I think sometimes we look past that. I think everyone kind of looks at, when you do spreadsheets, kind of like a widget, you plug this thing in, you plug that thing in, and then you get, said, number over here. But in all reality, we have to think about, hey, this is, a $50 million business we're running here if it's a $50 million property. And these are humans at the end of the day running this. And, you need to incentivize people, put the good stuff in place there to make sure that they're motivated and that, everyone is kind of working accordingly to accomplish the same goal. And, one thing that we've really done internally here, and now that I'm kind of spearheading more of the equity initiative, and Rob's, kind of taking a backseat away from that after he's trained me, he's really more focused on, I say, overall company function, but asset management and property management, just to make sure that we do in fact survive and thrive through this kind of economically difficult time for the apartment business. He's been really focused on making sure everyone, from maintenance people to leasing agents to the community property managers, everyone knows the why behind stuff, which is super important. Why do we want to have, tenants stay here and, get a renewal, not a new lease? Why is that important? Why is it important that, if there's a maintenance request going in, that's responded to quickly? So explaining everyone from kind of soup to nuts, from the highest level to the lowest level, if you will, not to be disparaging there, is super, super crucial.
Yeah, well said. And I think you bring up a good point that I want to ask about, and that's the operations side. Like you guys have done a great job of scaling your business over the last 3 years since you've been there, as you mentioned earlier. You're well on your way to $1 billion in assets under management by continuing to grow the firm, continuing to grow units under your belt. I believe Rob had moved down to Houston earlier this year or earlier in 2024 to kind of revamp that operations and asset management piece of the business. What does that look like going into 2025 for you guys in Lone Star? As you mentioned, it could be a more of a difficult time economically with where we're at within the market and the cycle. So really focusing on tightening up operations and making sure that stuff is tight. What does that look like for you guys heading into 2025 and moving forward?
Great question. So one thing, and by the way, Rob moved to Houston in May and was there all summer. And for those who don't know, Houston in the summer is probably top 15, 20 worst places to be in the world, maybe. It's not very fun.
Brutal.
It's not good. It's bad. I would probably prefer to be in your 20-degree New York weather, and I hate the cold. Like I loathe it. more than I want to be in Houston in the summer, just full disclosure.
Rob's
But
sweating through his suits.
sweating through his suits. Yeah, he actually started wearing Lululemon polos and the whole nine there. He changed his tune because, unfortunately, doing that much dry cleaning is no fun. But all that said, we had a mindset switch at the company, really, from a holistic perspective, we are a acquisitions company who operates real estate to now we are an operating company of real estate that also happens to acquire more real estate, because ultimately, if you can't, if you can't manage a property well, if you can't, basically deliver returns, get, your investment going, do well there's really no point in even acquiring the property, and you're not really trustworthy to invest with, right? So we've been really good for the longest time. I would say some of the best. I would say arguably over the last couple of years, particularly delivering unique value add. But recently, we've really focused more of our efforts on trying to become the best possible company on operations. And it's kind of funny, actually, legitimately, I think yesterday I asked a question. I was like, hey, out of curiosity, and I was like, this could be a dumb question because asset management, property management is not my shtick. I was like, does everyone else also struggle with property management and hiring? And Rob and everyone said it is the hardest thing to do unanimously throughout the kind of the business. Talent and on-site property managers is the hardest thing to hire for. So solving for that is the biggest question that we're working through right now. And we're doing a really good job of kind of turning around some properties that, we're struggling a touch just due to the change and whatnot. But that is the main point of emphasis there, is in fact that.
Yeah, and then there's a lot of benefits to bringing all of that in-house as well, right? And not leveraging third-party property management. Like you mentioned, you've got a lot more control. You can control the talent that is being brought in to that, but that doesn't automatically make that easy.
Well, there's certainly actually some really good third-party management too. Like, I don't want to say, there's anything terrible with that. Like, it's not the end of the world. I still think I would probably, like, let's say if I was a past investor knowing what I know, I would definitely be comfortable in some instances, for sure, investing with a group that's not vertically integrated if the deal made sense. And if I like the property management team on place there, like RPM, massive player in the space, they're probably really good at managing property. The only difference is just your reporting is different. And also, if a deal is not going well per se, you can kind of, get to the bottom of it a little bit quicker, hire and fire quickly. It's easier to do that than kind of moving the company off. So that's really, really beneficial. But also you can kind of reduce your costs there to kind of help the bottom line of the property if it's not performing how you like it to do as well. So those are some pretty important things to think about as well when you are kind of going through the conversation of vertically integrated or not vertically integrated.
Craig, what would you say are the top 5 things you look for when you are investing your money yourself? And I know you do investments within Lone Star, you do it outside. Kind of what are the top 5 things? I know there might be a list of 20 or even 30 or 40, but if you could pick 5, what would be the top 5 things you look for in an investment?
Yeah, so multifamily, the way I look at it is location. The location, it's cliche, but location. You got to like where, the property is situated. Like even things like where it's sitting on the street. Is it close to a highway? Are you close to a bus stop if it's workforce housing? What's the school district there like? What's the jobs nearby? Like for instance, Grand Riviera, right? Let's talk about that one. You had the DFW area or DFW airport, fourth busiest airport in the country, right nearby, and a bus stop, less than 3 minutes down the street. Crucial, right? Especially for these workforce tenants. So that was a big one. So I would say number 1 is location. Secondly, cash flow. Cash flow is really important for me. Personally, appreciation can be slightly speculative. We all like to think that, we're going to hit, a 2x equity multiple, but, having some cash flow along the way is really, really nice. So I definitely think that is certainly not to be looked past. So I like those 2 as my number 1 starters there. I would also say vintage. Not that I'm mad or, I'm ever going to want something too old, too new. I just need to know what the vintage is, for what reasons, because it needs to match the business plan to be logical. So those are my top 3 right there. And if I had to go down to the next ones, I guess location and market's pretty big there. I would say those 3 key ones are really solid. And then maybe positive leverage. Positive leverage is pretty crucial. So, and then maybe an affordable structure. Affordable structures just seem like kind of a cheat code to make money in many respects. So I think those are the 5 that I like.
I would probably add one more to that, and you probably could agree, is like operator track record. Like, what have they done in the past, and how can they prove what they've done to their investor base, right? Like, whether it's full cycle or not, what are the properties you have under management? How are your performas and your actual rent rolls, and your how are they actually performing versus how they were projected? And what does that look like moving forward? Because a lot of times you are betting on the jockey, betting on the operator to operate that property, how they project it. And no projection is going to go exactly how it's projected, right? It might be a little bit under, a little bit over, but to operate it to the most efficient way as possible so you can add value to not only the property, but to the investors as well. And
Well,
that's a
and
great point.
actually, yeah, I want to kind of harp on that a little bit more. That's a really good point. It's funny, if you gave the exact same property, like subject A property, to 10 different operators and 10 different people underwriting it, you're going to get 10 different answers. And then
Mhm.
if each 10 different people owned and operated that property, you're probably going to get 10 different results. So back to that, your expectations that you set on the front end, which is operator obviously specific, and how the deal actually goes is obviously operator specific as well. So making sure that you have good trust and have identified people who are professionals and experts that will take that property to the distance and will do what they say they're going to do is monumentally crucial.
Yeah, absolutely. And one thing that I want to elaborate on that too. So, a lot of our listeners to this podcast are probably successful W-2 employees that have thought about getting into real estate, maybe have gone into a single family house and have thought about scaling or thought about potentially investing it the passive way. What would you say to the listener who has not yet invested in a private placement or a multifamily deal or a real estate deal like this, right? So, if someone was listening, they're a little bit on the edge of the fence about, hey, is this the right strategy for me? I think getting into your first deal is probably the biggest step, and then you start to understand how these deals operate. But what would you say to those people listening that maybe not aren't sure if this is the right path for them to diversify, and why you really love this multifamily asset class and this investment strategy?
Yeah, well, it should be a piece of your portfolio, not the entire portfolio, right? Someone like
Yeah,
myself was probably going to
100%.
have a disproportionate amount of my net worth with Lone Star Capital for obvious reasons. It's not a mystery why, but you should have it to be a subset of your portfolio there. And if you're on the fence, like I get it, I mean, a lot of people who are, let's say if they're working at, a big company, they're probably very successful. Maybe they're a lawyer, maybe they're a doctor. They really only trust the hands that are on the end of their sleeves, right? They really only trust themselves. It's very uncomfortable for them to not have control, for them to not have liquidity opportunities and whatnot. But the sad thing is that if you only look at that way, you're not going to get into an asset class like ours that is, really awesome, very recession resistant, but also just a different piece of the pie. So as I said, it's not everything. It shouldn't be all of your, eggs in your basket, right? But it should really be a piece of your portion. And also, what eventually happens when you get to the big leagues, you own a bunch of properties, you're going to have a lot of assets, you're going to have very little time, and you're going to need a group like us to kind of help give you your some time back, right? So it just depends on the life cycle where you're at. This is not going to be, I wish it was hey, this is a pitch for everyone to get into it right away, but some people you can't sell and some people are not going to be the right fit for it. But that's fine. There's just going to be more for us and more for other people that will take advantage of the opportunity. But I will say that this, kind of sector is amazing. And I look around right now at the landscape of things with AI, with automation, all that going on. We don't know what the future is going to hold. But what we do know is that people are going to need a roof over their head to live. People are going to need shelter, and it's very expensive to replace it. If you look at all the new real estate coming online, what is it? It's a product, right? Well, there's a lot of a product that's kind of sitting vacant right now. The workforce stuff is amazing. It's very sticky. There's not enough of it. You can't replicate it. The Fed can't print it, and they're not making more land. So for those reasons, I think it's the best. But, you think about, retail, right? Well, retail's gotten very disruptive. You really can't disrupt multifamily housing or mobile homes, stuff like that, kind of that close to, I would say, floor of the housing market. So because of that, it's super crucial. And also, it's very hard to do that if you are an investor doing it yourself. What do I mean by that? Well, have you tried to get, a 20 unit loan, commercial loan? It's pulling teeth. It's not fun. You have to have a lot of money there. So you basically get to kind of walk into an opportunity like ours, or an opportunity that you guys present to your investors in a really cool way. where you get to walk in an opportunity as an investor, have everything queued up, don't have to sign on a loan. You can put, as little as $50,000 into a deal and everything gets streamlined for you. So you really are getting a service and a convenience that you would not be getting elsewhere. If you're buying a home, you got to go through mortgages, you got to go through tax returns. So there's just kind of a lot of headache and teeth pulling that goes with the traditional investing route, as opposed to this alternative space that we get to play in, that you guys are in, of course, as well.
And I think I would just add to that it's nerve-wracking wiring or ACHing that money, regardless of what point in your life you go ahead and do that, right? Sending money and putting that into someone else's hands to go and operate is nerve-wracking, again, at any point in time that you ultimately go ahead and do that. So that's not going to change, but I feel like it's changed the trajectory of how I am going to continue to invest and diversify my portfolio. Will it only ever be multifamily? No, there will be other things that I continue to invest in, but this is definitely going to form a significant piece of my investments moving forwards. And with that being said, go on, Brian, did you have something?
I was going to say, I think that's also important to just note on why due diligence is important, right? Like anyone who wants to get in this space, like you should still do due diligence as a passive investor, as an LP, as a limited partner. Like you should understand what investments you're getting into, what are some of the risks associated with that, right? Listening to podcasts, reading books, like understanding some of these alternative investments and why you want to place your money with the operator that you choose to go to or the property that you choose to go to. So just to add on what you were saying, Chris, like, yeah, it is like a little nerve wracking at times to be like, hey, I'm going to wire you 100K for this next deal, but you're doing it within understanding like, yeah, there are some risks associated with that, but you're having trust in what you've done due diligence on ultimately as well.
So, Craig, what is your outlook for 2025 for the multifamily market?
Yeah, well, it's funny. I don't know if you guys follow or know, and your audience knows someone by the name of Jay Parsons. Are you familiar with him? He's huge in the space. So he's awesome. If you on LinkedIn or your LinkedIn person, give him a follow. He's incredible. He's actually more bullish on the space, and I was kind of always pretty bullish because I think absorption is going to be good. But I'm overall pretty positive in the sense that, hey, there is obviously very strong demand. It's basically impossible for the average person now to buy a house with their mortgage rates are at. So what happens there? Well, more people are going to be in apartments. And also, there's also a trend too that people are going to be renting for longer. I mean, the new homeowner, the age of that has gone up substantially. So, renting for longer is more in vogue and a theme. And also there's kind of a general theme amongst millennials. Be curious to know your perspective on this. Granted, living in New York City makes things a touch different, but there's kind of a general theme away from home ownership for a lot of people too, which where does that go? It drives power back to the apartment complexes, right? So I am very bullish long-term about it. In the immediacy, there'll be some choppiness. But I think really the first half of 2025, we're going to see an oppressively slow market. And the reason that is because Q4 of 2024 had the election and then massive treasury volatility. Unfortunately, or for the better or worse, these buildings moving, think about this. It's not a speedboat that can make a quick little turn right away, can move on a dime. It's moving an aircraft carrier. And these aircraft carriers take a long time to work out. These sales cycles, when you do kind of go full cycle, soup to nuts, open to close on a deal, can take 6 months. And 6 months is a very long time. It's not like the stock market that can kind of change at the snap of a finger, right? So I do think that the market will be choppy due to the fact that, treasury volatility has been there, but there's still enough liquidity in the market. So I'm pretty bullish on the market, to be honest. I mean, yeah, there's obviously some problems and fundamentals, but if you haven't invested in the market yet, guess what? Those problems are precisely not yours. Those are your opportunities to kind of rebuy in a time here coming up. And, the way you have to look at this is when debt basically increases 3x in a 18-month span, like what has occurred from basically 2022 to kind of before, and even I guess call it a 2-year span, there's a lot of working out that has to be done. There's a lot of math that does not make any sense anymore. There's kind of a phrase, the math isn't mathing, right? I think it's kind of becoming a little bit of a thing, if you will, on Instagram and whatever, right? But the math isn't mathing for a lot of those people. So there's a lot of equity evaporation right now. But if you're an investor, that should be your sign to kind of get into the market and go into it. Another thing, obviously like anything else, right? Real estate is highly regional. Someone somewhere just bought the best deal that's made them a lot of money every single day of the year. And extremely convinced in that. So where we play is Houston and in Dallas. We've got a deal in San Antonio, and we're going to start buying in Phoenix actually in the new year as well, hopefully. So Phoenix is the new market we're merging into, which I'm sure, Bryan, you're not mad, and Chris, you guys aren't mad at, because when we do a property together and you come out and visit it, we'll have to play golf together. So it's not going to be a problem whatsoever there. We're going to have a good time. But those markets, right, are actually doing pretty well. Now, Phoenix has had a lot more distress than, the other markets that I mentioned, but Houston is rebounding really, really well. It didn't have that much supply going on. Dallas seemingly absorbs all the supply in the world. But let's kind of contextualize this, right? If you were in Austin, which is also in Texas, really messed up. They have 50,000 units being delivered, which is 15% of the market supply. So rent growth is down substantially. So it's negative rent growth, which is a problem. So if I was there, I'd be concerned. Considering my exposure, maybe I'm feeling more optimistic.
Well said. And obviously, you know your stuff. And I think you laid it out perfectly. And you could be excited for the opportunity. And what you mentioned about millennials, and I'll speak at least to my perspective on that, is I'm in no rush to buy my primary home. I know the American dream tells us that, we turn 30s, we get married, we have a kid, and we buy our house, and that's what we're supposed to do with the white picket fence out front. I mean, I love living in New York for the time being. I'm close to my U2 office and job. Jenna and I like living in a good part of town, and we enjoy being in the city. And at the time, we're in no rush. And with that said, like, it's becoming, and it is unaffordable for many of the people. Like, we're lucky that we do well for ourselves, and as well as you both do. But if you decide on buying a primary residence, you're locking up a lot of capital in a down payment in that house, and you better stay in that house for 7 years or longer, because you're paying all interest up front on that mortgage back to the bank, right? So like, if that house doesn't appreciate and you sell it before 7 years, or you decide to move somewhere else, like, you're going to likely lose money on that investment. And it also doesn't give you the flexibility that renting does. So I'm bullish on renting. Maybe it's because I have some properties myself, like, already. But at the same time, like, when that time's ready for us and Jenna, like, I'm ready to buy that. But we don't know where we're going to land yet. So eventually we'll probably get out of the city once kids force us out. But to be determined
Yeah,
in the
you'll go
future.
to you'll go to the burbs at some point, right? But
Yeah.
there's also another thing that you mentioned there, which is that spread. There's a massive spread right now too. That is actually, there's been studies on this. There's a graph, you could Google it. But the spread between homeownership and renting, right? And this is a massively crucial spread. That spread has never been wider, and that's because really the single family housing market, the multifamily housing market has come down a touch. Rents have kind of stayed maybe relatively stagnant, but home prices very regional, but in a lot of places have maybe come down a touch or maybe stayed neutral. But guess what? Mortgages are, from 2.5%, 3%, all the way to 7% right now. Well, that's a very big difference in a monthly payment perspective. Renting right now is a pretty good deal, which is a really good thesis for what we're doing here, which is multifamily investing.
Yeah, I am planning on buying probably in the fairly near future. However, what I will say is, before we identify the location, our plan is to short-term rent in different areas and different neighborhoods to identify where we want to ultimately finally buy. Now, that may take 6 months, that may take six years, right? And again, being able to work virtually makes big changes. You don't have to necessarily be right by your offices. So do you even need to live, like you said, in the cold in New York, or could you spend 3 months in Phoenix playing golf with Craig instead of being in the cold in New York, right? Like, those opportunities, when you have a house, you're not afforded those. Whereas if you're renting, you could rent for 3 months at a time in different areas within the country that ultimately suit your lifestyle and your needs. So again, I think everybody has slightly different views on that. I do think at some point I will purchase my first house, but I don't own a home at the moment. All of my investments in property are through multifamily investments. So again, I've rented for 10, 12 years at this point, and still don't own that home.
So with that said, actually, I've gone back and forth mentally on this one. Like, I see both sides of the argument. I see the side of, hey, I'm going to get in passives. I'm going to put my money in the S&P 500 because you get some data and that will outperform it. That's fine. And then I personally own my home. I sold one of my houses. I actually rolled the entire gain, not the principal, but the gain, into one of the deals we did last year. It's actually going really well. A little bit of a daredevil move, but I, made a very calculated risk. Then I bought my house and I levered it to the gills, because my goal here is to basically tear the sucker down, do new construction, and maybe refinance it or sell it in the future. Maybe I'll keep it, maybe I won't. But, that's more of an emotional choice. But you got to be really smart in the home play because you can lose your shirt there. But where I am in Arizona, it's very nice because I've got low property taxes and insurance, which makes the mortgage a little more palatable. And maybe we'll get a rate cut here in the future. Maybe we won't. But I kind of look around, like as you said, the 7-year plan there, Brian. Yeah, I feel very comfortable that, hey, this location, this area where I am in the city, being 10 minutes away from the airport, being close to everything I want to be, near the restaurants, near kind of the places, the freeways, the golf course you want to be near. This is where I want to be, and I'm cool with it.
You're not going anywhere, so you might as
No.
well settle in and buy your
Yeah,
property. Yeah,
exactly.
smart man.
Yeah.
No, that's awesome. But in wrapping up, we wanna thank you, Craig, for jumping on. What's next? I know we touched a little bit on 2025 and your views, but where is Lone Star Capital going? You're 3 years at the firm. I can only see you guys growing this even more in the years to come, and kind of looking forward to the future partnerships. So what's ahead for you guys? What's on your plate moving forward, and what does that look like for Lone Star?
You're going to laugh. This is going to be a very boring answer, but frankly, more of the same. Hopefully, more of you guys, more great partners, more great people. I mean, the best thing about this business, quite frankly, in my job is it's kind of funny. I've got like coworkers, but really my coworkers are you guys. My coworkers are the investors because I'm kind of on an island here. The company is at the One World Trade Center. Brian, you've been to the office. I'm on an island. I travel a lot for work, but my coworkers are as much as you guys as is the asset managers and whatnot. So I get to work with great people all day long, call people all day, have the great relationship. So I just want to keep doubling down on that. And I hope the firm, our goal is just to get better at operating and kind of just getting, as cliche as it sounds, incrementally better, 1% better each day. That's all you really need is just to show up, put your head down, do the right thing, do the work, and the rest will come. And I think a lot of people, me included, have this massive goal, but just take care of the day today and all that will come.
That's a great piece of advice there, Craig. I just want to say again from both of us, a huge thank you for joining us today. We will put all of the links to your socials into the description, as well as the Lone Star information. Where can people get hold of you, though, very, very quickly, and what should they be doing to reach out?
Yeah, I would say LinkedIn's best. LinkedIn, we're all there. So just add me, Craig McGrouther, links there. I'm sure you'll have the bio there. Then if you want to kind of research about touch more, go through due diligence, as Brian and Chris, you guys alluded to. The website we have, you'll probably put it in there, but it's just lscre.com. Very easy to find.
Thank you
Awesome.
very much,
Thank you, Craig. Appreciate your time and look forward to a nice glass of wine and cigar next month in Phoenix.
Absolutely, my friend. I look forward to it.
Thank you for tuning in to the Peak Profits Podcast. We hope today's episode was not only inspiring, but packed with actionable insights for your passive real estate investments. Subscribe so you never miss an episode. And if you enjoyed the show, please leave us a review. Your feedback fuels our passion to bring you even more valuable content. Stay connected with us on social media and visit 7peakcapital.com for exclusive resources and updates. Until next time, keep striving towards your financial goals, and let's reach new peaks together.
I would say number one is location. Secondly, cash flow. Cash flow is really important for me. Personally, appreciation can be slightly speculative. We all like to think that, we're going to hit, a 2x equity multiple, but, having some cash flow along the way is really, really nice. So I definitely think that is certainly not to be looked past. So I like those two as my number one starters there. I would also say vintage. Not that I'm mad or I'm ever going to want something too old, too new. I just need to know what the vintage is, for what reasons, because it needs to match the business plan to be logical. So those are my top three right there. And if I had to go down to the next ones, I guess location and market's pretty big there. I would say those three key ones are really solid. And then maybe positive leverage. I would say number one is location. Secondly, cash flow. Cash flow is really important for me. Personally, appreciation can be slightly speculative. We all like to think that, we're going to hit, a 2x equity multiple, but, having some cash flow along the way is really, really nice. So I definitely think that is certainly not to be looked past. So I like those two as my number one starters there. I would also say vintage. Not that I'm mad or I'm ever going to want something too old, too new. I just need to know what the vintage is, for what reasons, because it needs to match the business plan to be logical. So those are my top three right there. And if I had to go down to the next ones, I guess location and market's pretty big there. I would say those three key ones are really solid. And then maybe positive leverage.